Well, good morning, evening, afternoon, wherever you are in the world, and welcome to this video series on seed funding. How you can raise the seed funding you need without angels and VCs. My name is Michael Scott. Yes, just like the lead character on the Office TV series if you saw it, but I'm the original and much smarter. And I'm going to be your host today for this part 1 of this video series, where I review the top 15 mistakes most entrepreneurs make raising early seed funding. Now, we're going to be talking about all sources of seed money, including angels and VCs. But most of this content is focused on early seed money from other sources, particularly for your first $1 million, up to $3 million raised. Let's begin by defining what we mean when we say seed funding. Now, there are no established limits for seed funding, but for the purpose of our discussion today, we're talking about the first $25,000 up to $3 million or so of resources raised by a company for its early stage development. Seed funding can easily run to $5 million or even $10 million or more for some companies, and for others, they will raise their Series A round after their first $2 to $3 million. The primary parties that typically invest at the seed stage in order are the founder or founders, family and friends of the founders, and then there are what we call MLE investors. MLE is our acronym for Money Limited Experience, as well as seed accelerators, and finally, professional angel investors and venture capital. The first rule of seed funding is don't leave money on the table. And all these groups represent potential sources of seed investments that we're going to review right now. We start with the founders. Now, it's critical to understand people who write those early checks do so because they believe in the founders and see them as trustworthy. It's a 90+% emotional decision because there's little, if any, actual proof or evidence in the early days that the product or service can be built and successfully deployed in the market. Investors must believe in and trust the founder or founders. How much have you, the founder, personally invested? That's the first thing most investors will be asking. Sweat equity doesn't count. Founder capital can be in any form of cash, bank or product financing, or contractual commitment that results in cash proceeds or resources for an early stage company. And that includes development work and prototyping by third parties. Next, it's time for family and friends, which includes anyone who knows you. They don't have to be a good friend. Family and friends are crucial in the funding of a company's early days because they know you and believe in you. Now, MLE is our acronym for people with money but limited experience investing. MLE investors are often successful professionals like doctors, lawyers, engineers, and others who make a good income, some of which is disposable. And when it comes to seed funding, MLEs are the richest source of seed money for early stage companies, particularly your first $1 million. MLE investors will often write bigger checks than friends and family, which is terrific. And they almost always have other people in their network like them who also have money or income to spare, bringing other new, often larger investors to your party. Next are seed accelerators, startups accelerators. Accelerators are organizations that support seed and early stage startups through a formal, defined mentoring program from experts with experience across the startup spectrum. Programs typically last from 3 to 6 months and culminate in a demo day, where graduates showcase their businesses to investors, press, and potential customers. Membership is by application, and many accelerators specialize by vertical, geography, or type of company accepted. Accelerators invest early money in the companies they accept, but primarily are providing needed expertise to the founders. In exchange, an accelerator's investors receive equity, usually 7% or so. And finally, there are angel investors and venture capitalists who invest professionally, full or part-time, in risky early-stage companies in exchange for stock. They generally will not participate in a company's first $250,000 to $500,000 in funding, though there are a few that focus on pre-seed and seed investments that will invest after the first $100,000 or so, depending on the people and product. Angels and VCs often make the largest investments in a company's seed funding, but it's not always necessary to turn to them. Angels and VCs look at thousands of deals each year and invest in only a handful, making them a low percentage play for the funding you need. First and foremost, angels and VC investors are looking for proof of the business, product, and people, as well as evidence of a potentially huge opportunity. If you don't have proof yet, you shouldn't be approaching professional angels or VC investors until you do. Angel investors also have their own network and often invest alongside with people they know, as do venture capitalists. There are also angel groups made up of individual angel investors who meet regularly to socialize and review prospective investments. And today, thanks to changes in security laws over the last several years, particularly Reg CF or regulation crowdfunding, the ability to market your offering to thousands of potential investors is available through more than 60 different early-stage funding websites. But you have to be well along in your product and company development before even considering this route. The best way I can help you today is by sharing 3 proven strategies for raising seed funding, particularly early money, that first $1 million to $2 million. The first thing is to stop making some of the most common mistakes, and I'm going to touch on what they are. In the next video, we're going to go through 5 powerful components that you should have in your seed funding strategy in order to maximize your success. And lastly, we'll go through the things that you must be accomplishing with the seed funding you raise if you plan to raise more money in the future. Let's start with some of the most common mistakes most people make raising seed funding that you should avoid. Now, everyone's circumstances are different, but just know, if you keep making these mistakes, you are making it really hard to raise the money that you need. Number 1, if you are early in raising seed funding, like your first $1 million, 25 to 50% of your time as CEO will likely be spent raising money most weeks, or you'll run out of money. You can't wait until you need it to start talking to prospective investors. Number 2, wrong or low percentage investor targets will waste your time, discourage you, and can kill your entire fundraising efforts. We're going to go over who some of the low percentage investor people are in a few moments, as well as who are the right investor targets. Number 3, entrepreneurs can be lulled into putting all their eggs in one basket and with fingers crossed, hoping that one investor will come through while largely stopping the pursuit of other potential candidates. This is deadly on multiple levels for obvious reasons. Number 4, you can never use new investor money to pay off debts, especially to earlier sources of money. If that's in your plan, take it out. No new investor is going to let their money pay off a previous investor or money source. Everybody needs to be sharing the risk. If you have prior debts, settle them with stock and get them off your balance sheet that way. Number 5, you have to be clear on how much to raise now and for what. Remember, raising money is like climbing stairs. You must take risk off the table for your investors with each new round of funding to take the next step up, and that determines how much to raise now. Number 6, never get in front of angels or VCs before you're ready. Angels and VCs are professionals who don't play in the first money or early money realm of funding before there is proof. That's what you use your family, friends, and MLE investor money for. Number 7, You can't afford to burn up good leads. Actual investor prospects that really do write checks can be turned off if you are unprepared or too early in your own development when you approach them. So don't rush a meeting if you're not ready. Number 8, nothing will help you prepare more for real investors than to have warm-up presentations with people who have been there before, especially if they are professional investors. When you have little, if any, investor presentation experience and are raising seed money, especially early seed money, you need someone who is experienced to throw rocks at you. Not literally, of course, but someone who has been there needs to tell you what's wrong and missing. Number 9, particularly if you are raising your first $1 million, you're not ready to put a value on your company yet. Don't be lured by watching Shark Tank and think that's the only way to do it. Don't put a value on your company too early. Give yourself time to actually build value before setting a stock valuation. Number 10, if you don't have one already, get an attorney as well as an accountant who are experienced in security transactions and can prepare the necessary documentation. Having the right documents speaks volumes to your prospective investors and will help you raise the money you need. Number 11, be able to talk the talk about your stock or have someone else do it for you. Another reason to engage professionals in accounting and securities is for the education that they can give you, and sometimes they can help in closing investors. Anything that gives a prospective investor pause, like you fumbling through an explanation, lessens the chance they will make an investment. Number 12, prospective investors need something in hand or at hand. Not presenting a well-thought-out pitch deck will leave you empty-handed. Enthusiasm quickly wanes before investors write a check if they don't have something to review after meeting with you as proof of what they were investing in. Number 13, investors want a demonstration, even if it's just working wireframes. There is all kinds of free and low-cost software and 3D printing tools to build prototypes. People want to see something tangible that you can demonstrate, no matter how crude or ugly. Number 14, people need to believe what you say. Entrepreneurs can do many things right in building their company and still blow it with investors if their numbers are not believable and defensible. And finally, number 15, and my favorite, success in seed investing requires speedy decision making. And without a sweetener, your investment will lack urgency. Seed investing, particularly the early money, is largely driven by emotion, which includes using FOMO, an acronym for fear of missing out. Time is not your friend when it comes to closing one-on-one family, friends, and most MLE investors. Now you may be thinking, holy smokes, I made a whole bunch of those mistakes. That's okay. Just stop making them and watch the next video in this series. In the next series, we're going to be talking about the 5 components that you want to have in your seed funding strategy in order to find and close more money. Okay, that wraps up part 1 of this video series. I hope you found the information helpful and it in some way contributes to your success building your company. Be sure and watch part 2 of this series, where I reveal 5 key components that you want to have in your early seed funding strategy in order to find and close money, particularly from sources other than angels and VCs. Again, thank you so much for your time today. And feel free to connect with me on LinkedIn or send me an email if you'd like. Just please note in your message that you saw this video series. I would appreciate it. Again, I'm the original Michael Scott. May God bless your work, you, your family, and keep you safe. Peace out.